Before we begin, it's crucial to understand that I am not a licensed financial advisor or insurance agent. This video is intended for educational and informational purposes only and should not be considered as financial, legal, or insurance advice. The world of insurance is complex and state-specific. Always consult with a qualified and licensed professional in your state before making any decisions regarding your policy. Your personal situation is unique, and this presentation is a generalized guide designed to help you ask the right questions, not to provide definitive answers for your specific circumstances. Let's start with a scenario. You're driving home from work, maybe listening to a podcast, thinking about what's for dinner. Suddenly, you hear the gut-wrenching screech of tires and feel a violent jolt from behind. You've just been rear-ended. Your heart is hammering against your ribs. After you confirm everyone is okay, you exchange information. You call your insurance company, and that's when the real panic sets in. The person on the other end of the line starts using a language you don't understand. Words like liability, collision, subrogation, PIP, and deductible fly past you. You nod along pretending you get it, but a cold dread washes over you as you realize you have been paying hundreds, maybe thousands of dollars a year for a piece of paper you have never actually understood. This is not a rare feeling. This is the reality for the vast majority of drivers on the road today. And let's be brutally honest, that confusion isn't an accident. The insurance industry is built on complexity. They use jargon and convoluted contracts because a confused customer is a compliant customer. A compliant customer doesn't ask hard questions. A compliant customer just keeps paying the bill every month, praying they never have to use the very thing they're paying for. Well, that ends today. Right here, right now. The single most expensive financial mistake you are probably making isn't your daily coffee, or that subscription you forgot to cancel. It's blindly trusting a multi-trillion-dollar industry with your financial future, without knowing the rules of the game. This video is your rulebook. Over the next 10 parts, we are going to pull back the curtain on the entire car insurance industry. We are going to demystify every single line item on your policy. By the time you're done with this guide, you won't just understand your insurance. You will wield it as a tool. You will be able to read your policy with confidence, identify the dangerous gaps in your coverage that could leave you financially ruined, and know exactly how to shop for a policy that protects you and your family without paying a single penny for coverage you don't need. You'll finally understand what you're paying for. So, what even is car insurance at its most basic level? Forget all the fancy terms for a second. At its core, insurance is a simple contract. It's a promise. You promise to pay a company a regular fee called a premium. In exchange, they promise to cover certain specified financial losses if something bad happens. That's it. It's a transfer of risk. You are transferring the massive, potentially bankrupting financial risk of a car accident from yourself to a large company that has the resources to handle it. Think of it this way. Imagine you and 99 of your neighbors all live on the same street. Everyone has a car worth about $30,000. Now, you all know that in any given year, it's pretty likely that at least one person on the street is going to get into a serious accident and total their car. Nobody knows who it will be, but the odds say it's going to happen. If you're the unlucky one, you're suddenly out $30,000. That's a life-changing amount of money for most people. But what if all 100 of you decided to create a car-fixing fund? Everyone agrees to put $300 into a pot at the beginning of the year. That creates a fund of $30,000. Now, you're all just paying a small manageable amount. If you go the whole year without an accident, you're out $300 bucks. But if you're the one person who totals their car, the fund pays to replace it. You just turned a catastrophic $30,000 personal risk into a predictable $300 annual expense. You transferred your risk to the group. That is exactly what an insurance company does, just on a massive, massive scale. They collect premiums from millions of drivers, put it all into a giant pot of money, and use that money to pay for the claims of the unlucky few who get into accidents. The math they use to figure out the premiums is incredibly complex, involving your age, your car, your driving record, your zip code, even your credit score. But the fundamental concept is that simple. It's a giant shared safety net. So, if it's just a simple promise, why is the paperwork so impossible to understand? The answer lies in the details of that promise. The insurance company isn't promising to pay for everything. They are promising to pay for very specific things under very specific circumstances. And all of those specifics are outlined in your policy documents. Now, you probably got a thick packet of paper or a long PDF when you signed up, filled with dense legal language that would put anyone to sleep. 99% of people file it away and never look at it again. But there is one page in that packet that is the key to everything. It's the Rosetta Stone for your entire policy. It is called the Declarations page. Sometimes it's called the Deck page for short. This single page is a summary of your entire contract. It lists who is insured, what cars are covered, what specific coverages you have, the limits for each of those coverages, the cost of each coverage, and your deductibles. If you learn to read nothing else, you must learn to read your Declarations page. It is the single most important financial document related to your vehicle. I want you to do something right now, or as soon as this video is over. I want you to find your Declarations page. Log into your insurance company's website, open their app, or dig through that folder of important documents. Find it. Print it out if you can. Because for the rest of this guide, that page is going to be our map. Every section we break down, every term we define, you'll be able to see it right there on your own personal document. This is no longer going to be an abstract concept. We are going to make this real for you using your own policy. We're going to go through it piece by piece. We'll start with the absolute non-negotiable, the coverage you are legally required to have. Liability coverage. This is the part that protects you from financial ruin if you cause an accident that hurts someone else or damages their property. Then we'll move into the coverages that protect your car, like collision and comprehensive. We'll talk about the coverages that protect you and your passengers, like medical payments or personal injury protection. And we'll cover the critical, often overlooked coverages like uninsured and underinsured motorist protection, which might be the most important part of your entire policy. We're going to turn that confusing page of numbers and jargon into a tool you can use to protect your family and save money. Because understanding what's on that page is not just a nice skill to have. In today's world, it is a fundamental part of financial survival. The difference between knowing this stuff and not knowing it isn't just about saving a few dollars on your premium. It's the difference between a car accident being a bad day and a car accident being the day your entire financial world collapsed. So grab your Declarations page and let's begin. That first section you're looking at, usually right at the top, is liability coverage. And this is, without a doubt, the single most important part of your entire policy. It's also the most misunderstood. We're taught to think of car insurance as something that fixes our car if we mess up. But that's not what liability is for. Liability coverage has absolutely nothing to do with you or your car. It's for the other guy. It's the "I'm sorry I wrecked your car and sent you to the hospital" fund. It's the money that stands between you and a lawsuit that could haunt you for the rest of your life. This is the part that's legally required by almost every state. And because it's required, most people make a critical mistake. They just buy the bare minimum the state requires. They see state minimum liability and think, great, that's the official recommendation. It's not. It's the absolute least you can have to be legally on the road. Think of it like the minimum wage. It's the legal floor, not a suggestion for a comfortable living. Driving with state minimum liability is the financial equivalent of walking a tightrope over the Grand Canyon with a piece of dental floss. Let's break it down. You'll see a series of 3 numbers, typically separated by slashes. Something like 25/50/25 or 50/100/50. It looks like code, but it's the story of what happens the second you cause an accident. Let's use a common state minimum as an example. 25/50/25. The first number, the 25, stands for $25,000. This is the maximum amount your insurance company will pay for any single person's medical bills that you injure in an accident. One person, $25,000. Now you might think, 25 grand sounds like a lot of money. Let's test that theory. Imagine you're driving on a rainy Tuesday. You're a little distracted, you look down for just a second, and you rear end a Honda Odyssey. It's not a horrible crash, but it's a solid hit. The driver, a woman, gets a nasty case of whiplash and a concussion. The ambulance ride alone is $2,000. The emergency room visit with a CT scan to check for brain bleeding is another $10,000. She needs a few follow-up visits with specialists, physical therapy for her neck for a few months, and she misses 2 weeks of work. Suddenly, her bills are pushing $35,000. Your policy covers the first 25. The other 10,000? That's on you. The insurance company writes their check, wishes you luck, and walks away. You are now personally on the hook for 10 grand. But wait, it gets worse. Let's look at the second number in our 25/50/25 example. The 50. This stands for $50,000. That's the maximum amount your insurance will pay for all medical bills for everyone in the other car, combined, for the entire accident. So let's go back to that rainy Tuesday. You hit the Honda Odyssey, but the woman wasn't alone. Her husband was in the passenger seat. He broke his wrist trying to brace for impact. His medical bills, the ER, the x-rays, the cast, the orthopedic surgeon, come to $15,000. So we have the wife's bills at $35,000 and the husband's at $15,000. That's a total of $50,000 in medical expenses. Your policy has a $50,000 per accident limit. Perfect, right? You're covered. Not so fast. Remember the first number? The per person limit? Your policy will only pay a maximum of $25,000 for the wife. So even though you have a $50,000 total limit, they'll pay $25,000 for her, and the full $15,000 for the husband. That's a total payout of $40,000. You're still personally on the hook for the remaining $10,000 of the wife's bills. You see how the trap works? The limits work together, and they are not in your favor. Now imagine you didn't hit a minivan with 2 people. Imagine you caused a chain reaction on the freeway involving 3 cars and 6 people. Or you T-boned a car carrying a family of 4. That $50,000 limit evaporates in an instant. It's not a safety net, it's a puddle. Everything beyond that, every dollar of medical care, lost wages, and pain and suffering, becomes your personal debt. And that brings us to the third number, the final 25 in our 25/50/25 example. This is for property damage. It stands for $25,000, and it's the maximum your policy will pay to repair or replace anything you hit that isn't a person. This is mostly for the other person's car, but it also includes anything else you might damage. A mailbox, a guardrail, a fire hydrant, the front of a building. So you hit that Honda Odyssey. Let's say it's a few years old. The repair shop looks at the crushed bumper, the tailgate, the frame. But modern cars are packed with technology. There are backup cameras, parking sensors, blind spot monitors embedded in that bumper. The estimate comes back $18,000. Okay, you're still under your $25,000 limit. You're safe. But what if you hadn't hit a used Honda? What if you glanced away and rear-ended a brand new Ford F-150? Or a Lexus? Or a Tesla? The average price of a new car in the United States is over $48,000. If you total someone's new car, your $25,000 property damage limit doesn't even cover half of it. The other driver's insurance company will pay to replace their client's car. And then their lawyers will come after you for the remaining $23,000 plus fees. This is the nightmare scenario. You have an accident, your insurance pays out to its pathetic little limit, and then you get a certified letter in the mail. It's from an attorney. You're being sued for $150,000. People think, I don't have any money, they can't get anything from me. That is a dangerously naive way of thinking. They can get a judgment against you. That means they can garnish your wages for years, even decades. A percentage of every single paycheck you earn goes directly to them before you even see it. They can put a lien on your house, meaning you can't sell it without paying them first. They can seize your assets, drain your bank accounts. This is what I meant when I said a car accident can collapse your entire financial world. It's a debt you can't escape. All because you tried to save $8 a month on your car insurance premium. So what's the answer? You need to raise your liability limits dramatically. No one who understands how this works carries state minimum insurance. Talk to any insurance professional, any financial advisor. They will tell you the absolute lowest you should ever consider is 100/300/100. That's $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. A much safer and more common recommendation for a typical middle-class family is $250/500/100. And here's the secret the insurance companies don't advertise. The price difference to go from a dangerously low state minimum policy to a truly protective 100/300/100 policy is shockingly small. We're often talking about the price of a few cups of coffee a month. The jump from 25/50/25 to 100/300/100 might cost you an extra $15 or $20 per month. It is the single best investment you can make in your financial security. You are buying hundreds of thousands of dollars of protection for pocket change. So take a hard look at your declarations page. Look at those 3 little numbers. Ask yourself, if I caused a serious accident tomorrow, is this a puddle or is this a safety net? Is this enough to protect my family, my home, my future? Or is it just enough to be legal, while leaving me one mistake away from total financial ruin? Now, all of this has been about protecting yourself from the costs of hurting other people and breaking their things. We've covered your liability, but that's only half the story. What about your own car? If you hit that Odyssey, your liability coverage does absolutely nothing to fix your own crushed front end. It won't pay for your rental car. It won't pay to replace your vehicle if it's totaled. You're left standing on the side of the road with a wrecked car, a bill from the tow truck, and no way to get to work tomorrow. To protect yourself, you need two completely different kinds of coverage. And that's where the next section of your policy, collision and comprehensive, comes into play. Let's be honest, we all think we're good drivers. You follow the speed limit, you use your turn signal, you don't text and drive. But what happens when you're leaving the grocery store? You're distracted for just a split second, and you hear that gut-wrenching crunch of metal on metal as your brand new SUV backs squarely into a concrete light pole. Or what about when a driver runs a red light and plows into your side? We established that your liability coverage pays for the other guy's damage. It does absolutely nothing for your car. Zero. That's a hard lesson to learn standing in a rainy parking lot with a shattered taillight and a dent the size of a watermelon. This is exactly why collision coverage exists. It is the first of the two coverages designed to protect your actual vehicle. The name is pretty straightforward. Collision pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a guardrail, a telephone pole, a garage door you forgot to open, you name it. If you hit something, collision is your hero. But here's how it actually works, and this is where most people get tripped up. It all comes down to one word: deductible. Your deductible is the amount of money you have to pay out of pocket for a repair before your insurance company starts paying. Think of it as your share of the cost. A common deductible is $500 or maybe $1,000. So let's go back to that parking lot pole. You get an estimate from the body shop, and it's going to cost $3,000 to fix your bumper and taillight. If you have a $500 deductible, you pay the first $500, and your insurance company sends a check for the remaining $2,500. If the damage was only $400, well, since that's less than your deductible, you just pay for it yourself. It's not even worth filing a claim. Now, here's a secret that most people don't realize about collision coverage, and it's arguably the most important reason to have it. It protects you from the millions of drivers who are either uninsured or, more likely, underinsured. Remember how we talked about state minimum liability limits being shockingly low? Imagine someone with only $10,000 in property damage liability slams into your $40,000 truck and totals it. Their insurance will pay out its max, $10,000. Then what? They're legally on the hook for the other $30,000, but let's be real. If someone can only afford minimum insurance, they probably don't have $30,000 sitting in the bank. You could sue them, but you can't get blood from a stone. You'd be stuck. But if you have collision coverage on your own policy, you're protected. You simply file the claim with your own insurance company. You pay your deductible, say $1,000, and they will pay the rest to replace your truck. Then they'll go through the nightmare of trying to get that money back from the at-fault driver. That's their problem now, not yours. You're already back on the road. Without collision coverage, you're gambling that every single other driver on the road has enough insurance to cover the value of your car. That is a very, very risky bet. So, collision covers you when you hit things. But what about all the other chaos the world can throw at your car when it's just sitting there, minding its own business? What about the hailstorm that turns your car's hood into a golf ball? Or the massive oak tree branch that snaps in a windstorm and crushes your roof? What if you walk outside in the morning to find your car gone, stolen right out of your driveway? Or maybe you hit a deer on a dark country road. None of these are a collision in the traditional sense. And that's where the second hero of our story comes in: comprehensive coverage. Comprehensive, sometimes called other than collision coverage, is the catch-all for almost everything else. It's for the random, unpredictable, non-collision events. Fire, theft, vandalism, floods, falling objects, riots, explosions, and yes, hitting an animal. It's the universe out to get your car insurance. The process works just like collision. An unfortunate event happens, you file a claim, you pay your comprehensive deductible, which can be different from your collision deductible, and the insurance company pays for the rest of the repair or replacement. So, the big question is, do you actually need these? Unlike liability, no state legally requires you to carry collision or comprehensive. So why does almost everyone with a newer car have them? The answer is simple: the bank. If you have a loan or a lease on your car, Your lender will absolutely 100% require you to have both collision and comprehensive coverage. Why? Because until you pay it off, that car isn't really yours. It's the bank's asset. It's their collateral for the loan they gave you. They need to protect their investment. If you total that car and don't have the coverage to fix or replace it, you'll likely stop making payments. The bank would be out tens of thousands of dollars. So they mandate this coverage, and they'll even require you to list them on the policy as the loss payee. Meaning any check for a total loss goes to them first to pay off your loan. But what if you own your car outright? What if you have the title free and clear? Then the decision is entirely up to you. It becomes a simple, personal financial calculation. Ask yourself this one question. If my car were totaled tomorrow, could I afford to buy another one just like it with cash, without it causing a major financial crisis? If the answer is no, you probably need the coverage. If your car is a 10-year-old beater worth $1,500, and you have savings set aside, it makes very little sense to pay hundreds of dollars a year to insure it against damage. The cost of the insurance will quickly outweigh the value of the car. But if you're driving a 5-year-old car worth $20,000, paying $600 or $700 a year for collision and comprehensive is a no-brainer. It's transferring the risk of a $20,000 loss to an insurance company for a manageable annual fee. The last piece of this puzzle is deciding on your deductible amount. Insurance companies will offer you a range, typically from $250 all the way up to $2,500. And this is where you can really customize your policy to fit your budget. The rule is simple. A higher deductible means a lower premium. A lower deductible means a higher premium. By choosing a higher deductible, you're telling the insurance company, I'm willing to take on more of the financial risk myself, so you should charge me less every month. If you pick a $2,000 deductible instead of a $500 one, your premium could drop significantly. But you have to be brutally honest with yourself. Could you easily write a check for $2,000 tomorrow if you had to? If not, then a super high deductible, while tempting for the lower monthly payment, could be a financial disaster waiting to happen. The sweet spot for most people is usually $500 or $1,000. A painful but manageable amount that keeps the monthly premium reasonable. So now you understand how to protect your car from, well, pretty much everything. From your own mistakes, from other drivers, and from acts of God. You're covered if it's crumpled, and you're covered if it's stolen. But we've only talked about the vehicle. We haven't talked about the most valuable thing in the vehicle, you and your passengers. What happens when an accident leaves you with a mountain of medical bills? Who pays for the ambulance, the emergency room, the physical therapy? Your health insurance? Maybe. But car insurance has its own very specific coverages for injuries, and in some states they are mandatory. Getting this part wrong can be even more devastating than losing your car. And that's exactly what we're going to break down next. When we talk about accidents, it's easy to picture twisted metal and shattered glass. But the human body is far more fragile than a steel frame. A minor fender bender can lead to a lifetime of chronic pain, and a serious crash, well, the cost can be astronomical. We're not just talking about a few $1,000s for an emergency room visit. We're talking about surgeries, physical therapy, lost wages, and long-term care. Costs that can easily climb into the hundreds of thousands or even millions of dollars. This is where the most critical part of your insurance policy comes into play. Liability coverage for bodily injury. This isn't for you. Let's be crystal clear about that. Bodily injury liability, or BI as you'll see it, does absolutely nothing to cover your own medical bills. This coverage is exclusively for the injuries you cause to other people. The driver and passengers in the car you hit. The pedestrian you didn't see. The cyclist who swerved into your path. Let's go back to that dreaded scenario. You're at fault for an accident. The other driver is complaining of a sore neck and is taken to the hospital in an ambulance. Your bodily injury liability is what pays for their ambulance ride, their hospital stay, their doctor's visits, their physical therapy, and potentially even their pain and suffering. Now look at your policy's declaration page. You'll likely see two numbers associated with bodily injury, written something like this: 50/100. This isn't a fraction. These are your limits. The first number is the maximum amount your insurance will pay for any one person's injuries in an accident. In this example, that's $50,000. The second number is the maximum total amount your insurance will pay for all injuries in a single accident, no matter how many people are hurt. Here, that's $100,000. So, if you hit a car with one person in it, your policy will pay up to $50,000 for their medical needs. If you hit a minivan with 4 people in it, your policy will pay a total of $100,000, but no more than $50,000 for any single one of them. And this is where millions of Americans make a catastrophic financial mistake. They choose the state minimum limits. Many states only require something like 25/50ths. That's $25,000 per person and $50,000 per accident. Let me ask you a question. When was the last time you heard of a major medical procedure that only cost $25,000? A single night in a hospital can cost thousands. An MRI? Thousands more. A simple surgery? You're easily past that $25,000 limit before the anesthesia even wears off. And what happens when the bills exceed your coverage limit? The insurance company writes a check for $25,000 and washes its hands of the situation. The rest? That's on you. The injured person's lawyer won't just shrug and walk away. They will come after you personally. They will sue you for your assets. They can garnish your wages for years, put a lien on your house, and seize your savings. A single accident, a moment of distraction, can financially ruin you for the rest of your life simply because you tried to save $10 a month on your car insurance premium. This is not an exaggeration. It happens every single day. Bodily injury liability isn't about protecting your car. It's about protecting your future. It's a shield for everything you own and everything you will ever earn. Upping your limits from the state minimum to something more substantial, like 100/300 or even 250/500, is often one of the cheapest and most important upgrades you can make to your policy. Okay, so that covers the people you hit. But what about you? What about your passengers? Your bodily injury liability won't pay a dime for you. So what does? This is where two other coverages come in: medical payments coverage, often called MedPay, and personal injury protection, or PIP. Let's start with MedPay. This is the simpler of the two. It's an optional coverage in most states that pays for medical expenses for you and your passengers after an accident, regardless of who was at fault. If you get rear-ended, it pays. If you cause the accident, it pays. It covers things like health insurance deductibles, co-pays, ambulance rides, dental work, and even funeral expenses. You typically buy it in set amounts like $1,000, $5,000, or $10,000. It's relatively inexpensive and acts as a small, immediate pool of cash for medical bills before the bigger, more complicated questions of fault and liability are sorted out. Now, for personal injury protection, or PIP, this one is a little more complex because it depends heavily on where you live. About a dozen states, known as no-fault states, actually require you to carry PIP coverage. What does no-fault mean? It means that if there's an accident, each person's own insurance company pays for their initial medical bills up to their PIP limit, no matter who caused the crash. The idea is to get people immediate medical care without waiting for a lengthy legal battle to determine who's at fault. So if you live in a no-fault state like Florida, Michigan, or New York, you don't have a choice, you must have PIP. And PIP is much broader than MedPay. Not only does it cover medical bills, but its real power is that it also covers a portion of your lost wages if the injury prevents you from working. It can even pay for replacement services, like hiring someone to clean your house or take care of your kids if you're laid up in bed. It's a much more comprehensive safety net. In states that are not no-fault, known as tort states or at-fault states, the person who causes the accident is responsible for the damages. In these states, PIP might be offered as an optional coverage, or you might just have the option for MedPay. So, how does this all work with your regular health insurance? It's a great question. Generally, MedPay or PIP is considered primary for car accident injuries. This means it pays out first before your health insurance ever sees a bill. This can be fantastic because it can cover your entire health insurance deductible, leaving you with zero out-of-pocket costs for your medical care. Once your MedPay or PIP limit is exhausted, your health insurance would then kick in as the secondary payer. Let's put it all together. You cause an accident, your bodily injury liability pays for the medical bills of the people in the other car. You need high limits here to protect your life savings. Your PIP or MedPay covers the immediate medical bills for you and your own passengers. This gets you treated quickly without worrying about fault or health insurance deductibles. You see how they are two sides of the same coin? One protects others from you and the other protects you and your own. Getting these coverages right is the difference between a terrible event being a manageable inconvenience or a financial apocalypse you never recover from. It's about more than just being legal. It's about being smart and protected. We've now covered damage to their car, damage to your car, and injuries to everyone involved, assuming the other driver is a responsible person. But what happens when they aren't? What happens if the person who plows into you at an intersection has zero insurance? Or they have those laughably low state minimum limits that won't even cover half of your totaled car, let alone your medical bills? You did everything right. You bought the right coverage. And yet, you could be left standing on the side of the road with a wrecked car, a broken arm, and a bill that belongs to someone who has no way of ever paying it. What happens then? It's a driver's worst nightmare, and it's covered by two of the most misunderstood, yet critically important parts of your policy. And that's what we're untangling next. These two coverages are your personal financial bodyguards against the most unpredictable threat on the road: other drivers. They are uninsured motorist and underinsured motorist coverage, often abbreviated as UM and UIM. And honestly, for the few extra dollars they might cost per month, they could be the single most important line items on your entire policy. Let's start with the most straightforward nightmare: uninsured motorist coverage. The name says it all. You're driving responsibly, stopped at a red light and BAM. Someone plows into your back bumper. They get out, they're apologetic, but then they drop the bomb. I don't have insurance. Or even worse, it's a hit and run. They speed off and you never get their information. In this moment, your entire financial world is hanging by a thread. Your car is damaged, you're injured, maybe seriously. Your liability coverage does nothing for you. That's for damage you caused to others. Your collision coverage can fix your car, but you'll have to pay your deductible first. But what about your body? What about the ambulance ride, the hospital bills, the physical therapy? What about the weeks or months you can't work while you recover? This is where uninsured motorist bodily injury, or UMBI, swoops in like a superhero. It is designed to pay for your medical expenses, your lost wages, and even your pain and suffering, up to the limits you select, when you are hit by a driver who has zero insurance. Essentially, your own insurance company steps into the shoes of the uninsured driver's non-existent insurance company and pays you what they should have paid. Think about that for a second. Without UMBI, your only real option is to sue the at-fault driver personally. But let's be realistic. If someone can't afford a basic car insurance policy, what are the chances they have tens or hundreds of thousands of dollars in assets just sitting around for you to claim in a lawsuit? The odds are practically zero. You can win a lawsuit and still get nothing. It's called a paper judgment, worthless. So you're left to rely on your personal health insurance, which comes with its own high deductibles, co-pays, and coverage limits. And it certainly won't pay you a dime for the wages you lost while you couldn't work. UMBI covers all of that. Now there's a second part to this: uninsured motorist property damage, or UMPD. This is designed to repair or replace your car if it's damaged by an uninsured driver. But here's a pro tip. This coverage can sometimes be redundant. If you already have collision coverage on your policy, which we discussed earlier, your car is covered for accident damage regardless of who is at fault, including a hit and run or a collision with an uninsured driver. So why would anyone get UMPD? In some states, the UMPD deductible can be much lower than your collision deductible. For example, your collision deductible might be $1,000, but your UMPD deductible could be just $250. It's a small detail that can save you a good chunk of money in a very specific and unfortunately common scenario. But now let's talk about the sneakiest villain on the road. Not the driver with no insurance, but the driver with not enough insurance. This is where underinsured motorist coverage, or UIM, becomes your shield. Imagine the exact same accident. Someone runs a red light and T-bones your car. This time they're a responsible person. They have insurance. The problem? They only have the bare minimum required by their state. Let's say their state minimum for bodily injury liability is $25,000 per person. That sounds like a lot of money until you're the one in the ambulance. One serious accident can obliterate that $25,000 limit in the blink of an eye. The ambulance ride, the emergency room visit, the MRI, the surgery to repair a broken bone, the follow-up appointments, your medical bills alone could easily soar to $75,000, $100,000, or even more. The at-fault driver's insurance company will write you a check for their policy limit, $25,000, and then they'll wash their hands of the situation. They've fulfilled their legal obligation. So now what? You're left with a mountain of medical debt, maybe $50,000 or $75,000 that isn't covered. You're still out of work, and the person who caused all of this is legally off the hook. It is a terrifyingly common loophole that leaves good, responsible drivers financially devastated every single day. This is the exact gap that underinsured motorist coverage is built to fill. After the other driver's insurance pays out its maximum, your UIM coverage kicks in and pays the rest, all the way up to your own UIM policy limit. So if you have $100,000 in UIM coverage, and your bills are $75,000, you're covered. It bridges the gap between the other driver's pathetic limit and your actual costs. It protects you from being punished for another person's decision to carry the cheapest, most inadequate insurance possible. This is why the limits you choose for your own and UIM coverage are so critical. A common piece of advice from insurance experts is to set your uninsured and underinsured motorist limits to be the same as your own bodily injury liability limits. If you think you're capable of causing $100,000 of harm to someone else, you should absolutely believe someone else is capable of causing that much harm to you. You are protecting yourself and your family with the same level of coverage you're required to have for others. Now, in some states, there's an advanced option called stacking. If you have multiple cars on your policy, stacking allows you to combine the UIM limits from each car to create a much larger pool of coverage. For example, if you have 2 cars, each with $100,000 of UIM coverage, stacking them could give you a total of $200,000 of protection if you're in a serious accident. It costs a bit more, and it's not available everywhere. But if you have a family and multiple vehicles, it's a powerful option worth asking your agent about. So, why are we spending so much time on this? Because the statistics are staggering. The Insurance Research Council estimates that about 1 in every 8 drivers in the United States is uninsured. That's more than 12% of the cars you see on your commute every single day. In some states, that number is as high as 1 in 4. You are rolling the dice every single time you pull out of your driveway. People make the catastrophic mistake of looking at their insurance declaration page and seeing UM/UIM as an optional extra they can cut to save $20 a year. They see it as just another line item. But it isn't. It is a shield. It is the only thing that stands between you and financial ruin caused by someone you've never met. Someone who made the irresponsible choice to drive without proper protection. Declining this coverage is like firing your own bodyguard to save pocket change. It's a gamble against the odds, and the stakes are your health, your home, and your family's future. So you've now protected yourself from the uninsured and the underinsured. Your financial fortress is looking strong. But there's another, more immediate layer of protection we need to talk about. What about the gray area? The ambulance ride, the emergency room copays, the immediate health costs that pile up long before the insurance companies have even decided who is at fault? There's a part of your policy designed specifically for this immediate financial first aid. In some states it's mandatory and others it's optional, and it works in a completely different way from everything we've just discussed. And getting this part right can be the difference between peace of mind and panic in the critical hours after a crash. We're talking about a type of coverage called personal injury protection, or PIP. You might also hear about its close cousin, medical payments coverage, often called MedPay. These two coverages are designed to answer one of the most terrifying questions you can face after an accident. Who is going to pay for my medical bills right now? See, when there's a crash, everything we've discussed so far, bodily injury and property damage liability, is about paying for the other person's problems if you're at fault. But what about you? What about your passengers? Let's say someone runs a red light and T-bones your car. They are clearly 100% at fault. Great. So their bodily injury liability insurance will eventually pay for your hospital bills, right? Yes, eventually. That's the key word. Eventually could mean weeks, could mean months, could mean over a year if lawyers get involved. But your hospital bill for the ambulance ride, the ER visit, the x-rays, that's not due eventually. It's due in 30 days. Your boss isn't going to pay you eventually for the 2 weeks of work you missed because you were recovering from a concussion. You need that money for rent now. This is the gap. This is the financial black hole that can swallow people whole, even when they weren't at fault. You're injured, you're stressed, and now you're getting threatening letters from a hospital billing department. It's a nightmare. And this is the nightmare that personal injury protection was invented to prevent. PIP is what's known as no-fault coverage. And that's the most important concept to understand. It's called no-fault because it pays out no matter who was at fault for the accident. You could be hit by a drunk driver, or you could slide on ice and hit a tree. It doesn't matter. Your PIP coverage is there for you. It's your financial first responder. So what exactly does it cover? It's incredibly broad. First, and most obviously, it covers medical expenses. This includes everything from the ambulance and the emergency room to follow-up doctor visits, surgeries, and physical therapy. It's designed to get you the care you need without you having to drain your savings account while you wait for a settlement from the other driver's insurance company. but it goes so much further than that. This is what makes PIP so powerful. It can also cover lost wages. If your doctor says you can't work for 3 weeks because of your injuries, PIP can reimburse you for a significant portion of your missed paychecks. For most families, losing even one paycheck is a catastrophe. PIP acts as a critical safety net to keep your finances afloat while you recover. It doesn't stop there. In many states, PIP can also cover what are called essential services. This is a game changer. Let's say you're a stay-at-home parent and you break your leg in an accident. You can't take care of your kids, you can't clean the house, you can't do the things you normally do. PIP can actually help pay for services like childcare or a cleaning service to help you manage your household while you're laid up. And in the worst-case scenario, it also provides a funeral expense benefit. It's a grim thought, but it's a crucial protection that can relieve a massive financial burden from a grieving family. This is why in about a dozen states known as no-fault states, carrying PIP is mandatory. States like Florida, Michigan, New York, and others have decided that this immediate protection is so important that every driver must have it. In these states, after an accident, you don't start by fighting with the other driver's insurance. You start by filing a claim with your own insurance under your own PIP coverage. It's faster, it's more efficient, and it dramatically reduces the number of lawsuits over smaller injuries, because everyone's own insurance handles their initial costs. Now, what if you don't live in a no-fault state? You might have the option to buy medical payments coverage or MedPay. Think of MedPay as PIP Lite. It's also a no-fault coverage, meaning it pays out regardless of who caused the accident, and it covers you, your family members, and your passengers. The key difference is that MedPay only covers medical and funeral expenses. It does not cover lost wages or essential services. It's a much simpler, more streamlined coverage. So why would you want it? Because it's still an incredibly valuable layer of protection. If you have a high-deductible health insurance plan, MedPay can be used to pay that deductible. If you have passengers in your car who get hurt, your MedPay can cover their immediate medical bills, which can prevent a very awkward and difficult situation with a friend or family member. And just like PIP, it pays out quickly without waiting to determine fault. It's an immediate pool of money available for medical treatment. Let's put this into a real-world context. Imagine 2 scenarios. In scenario A, you live in an at-fault state and you get in a crash that isn't your fault. You have a $5,000 health insurance deductible. You go to the ER and the bill is $4,000. Without MedPay, you're on the hook for that $4,000 out of pocket right now. You'll have to try and get it back from the at-fault driver's insurance company, which could take months of phone calls and paperwork. In scenario B, you have the exact same accident, but you have $5,000 in MedPay coverage on your auto policy. The hospital bill comes. You simply submit it to your own car insurance company, and they pay it directly from your MedPay coverage. Done. No deductible, no waiting, no stress. You've essentially created your own emergency medical fund specifically for car accidents. When you're looking at your policy, choosing your PIP or MedPay limit is a big decision. With PIP, especially in states where it's mandatory, the required limits can be quite high, sometimes covering hundreds of thousands of dollars in medical expenses. With MedPay, it's often more modest, with common options being $1,000, $5,000, or $10,000. So how do you choose? You need to look at your health insurance. What's your deductible? What's your out-of-pocket maximum? If you have a high-deductible plan, having at least enough MedPay or PIP to cover that deductible is a very smart move. Do you frequently drive with passengers, like carpooling for work or taking your kids' friends to soccer practice? Having a higher MedPay limit protects them and, by extension, protects you from being sued by them for their medical bills. It's about creating a seamless bridge. A bridge from the moment of impact to the moment you're fully recovered, both physically and financially. Liability coverage protects your assets from others, but PIP and MedPay protect your well-being. They protect your peace of mind. They ensure that in the confusing, painful, and chaotic hours and days after a crash, the one thing you don't have to worry about is how you're going to afford to get better. So now you're covered, your passengers are covered, and your immediate financial shock is absorbed. But as you stand on the side of the road, looking at your crumpled bumper and shattered headlight, you realize there's a whole other financial nightmare just beginning. Who pays to fix your car? The answer is more complicated than you think, and it involves 2 of the most misunderstood words in all of insurance, words that determine whether a tree falling on your car in the driveway and a fender bender in the parking lot are treated the same, or as completely different worlds. Those 2 words are collision and comprehensive, and understanding the Grand Canyon-sized gap between them is the key to protecting your own vehicle. not just other people's. Let's start with collision. It sounds simple, right? It covers you when you collide with something. And for the most part, that's exactly what it is. But the devil is in the details. Collision coverage is designed to pay for repairs to your car after an accident that is deemed your fault. Imagine you're in a crowded mall parking lot during the holidays. You're backing out, you check your mirrors, you check your camera, but you misjudge the angle of that concrete pillar. Crunch. That sickening sound of metal on concrete. Your bumper is dented, your taillight is shattered. That's a collision. Your liability coverage, which we talked about before, does nothing for you here. It protects the owner of the parking lot from you suing them, but it won't pay a dime to fix your car. That's where collision coverage swoops in. You pay your deductible. Let's say it's $500, and your insurance company pays the rest of the repair bill, whether it's $800 or $8,000. Or think about a more common scenario. A fender bender at a stoplight. The light turns green, you think the car in front of you is going, you look away for a split second, and you tap on the gas. But they hadn't moved. You bump into their rear end. It's a low-speed impact, but it's enough to crumple your hood and crack your grille. In almost every state, if you rear-end someone, you are automatically considered at fault. Again, your liability insurance will pay to fix their car. But to fix your car, you need collision coverage. Without it, you're on your own. You're writing a check to the body shop for the full amount, or you're driving around in a car that looks like it lost a fight. Collision is your financial shield when you make a mistake behind the wheel. It even protects you in a hit and run, or if the person who hits you is uninsured and you can't get money from them. In those cases, your insurance company will often use your collision coverage to fix your car, and then they'll go after the other driver to get their money back. It's your safety net for the physical value of your vehicle in the event of a crash. Now let's talk about its partner, comprehensive coverage. This is where things get interesting. If collision is for crashes, comprehensive is for chaos. It's for all the weird, unpredictable, non-driving related stuff that can destroy your car. This is the coverage that pays for that tree branch falling on your roof during a windstorm. You didn't collide with the tree. The tree collided with you. That's a comprehensive claim. A hailstorm rolls through town and turns your brand new SUV's hood into the surface of a golf ball. You didn't collide with the hail. That's a comprehensive claim. You're driving down a country road at dusk, and a deer makes the fateful decision to leap in front of your car. Now you might think, I collided with a deer, so that's collision, right? Wrong. In the world of insurance, hitting an animal is considered an act of nature, a random event outside of your control. That's a comprehensive claim, and it covers so much more. Theft. You walk out in the morning and your car is just gone. Comprehensive. A thief smashes your window to steal your laptop bag. Comprehensive will pay to replace the window, though not the laptop itself. That's for your homeowner's or renter's insurance. Vandalism. Someone keys your door. Fire. An electrical short starts a blaze under the hood. A flood. Your car gets swamped in a flash flood. All of these fall under the umbrella of comprehensive coverage. It's the life happens policy for your car. Just like collision, comprehensive coverage has a deductible. You choose the amount you're willing to pay out of pocket before the insurance kicks in. Common question people have is, why are they separate? Why not just one bucket of money for damage to my car? It's because the risks are fundamentally different. Collision risk is based on your driving record, your age, where you drive, and how many miles you drive. It's about your behavior. Comprehensive risk is based more on where you live. Do you live in an area with high rates of auto theft? Do you live in Tornado Alley or a hurricane-prone state? That's why you can often get a different, sometimes lower, deductible for comprehensive than you can for collision. So this brings us to the million-dollar question, or at least the several $1,000 question. Do you actually need both? If you have a loan or a lease on your car, the answer is almost certainly yes. Your lender, the bank or the finance company, technically owns the car until you pay it off. It's their asset and they want to protect their investment. They will almost universally require you to carry both collision and comprehensive, what's commonly referred to as full coverage, for the entire life of the loan. If you drop it, they can legally take out a policy on your behalf and charge you an exorbitant rate for it. But what if you own your car free and clear? The title is in your name in your filing cabinet. Now the decision is entirely yours. And it's not an emotional one. It's a simple math problem. You have to weigh the cost of the coverage against the value of your car. Let's create a character. Let's call him Dave. Dave drives a 12-year-old sedan. It runs great, but it's got 150,000 miles on it. The Blue Book value is about $3,000. Dave is paying about $800 a year for his collision and comprehensive coverage, and he has a $1,000 deductible for both. Let's do the math. If Dave gets into an accident and totals his car, the absolute most his insurance company will pay out is the actual cash value of the car, which is $3,000. But first, Dave has to pay his $1,000 deductible. So, the check he receives from the insurance company will be for $2,000. Is it worth paying $800 every single year to protect a potential $2,000 payout? For Dave, probably not. He's paying a huge premium to protect a relatively small asset. He would likely be better off dropping collision and comprehensive, taking that $800 he saves each year, and putting it into a dedicated savings account. In just a few years, he'd have more than enough saved up to cover a major repair or even replace the car entirely if something happened. He'd be self-insuring. Now let's meet Sarah. Sarah just bought a 2-year-old SUV worth $35,000. She also pays $800 a year for collision and comprehensive with a $1,000 deductible. If Sarah totals her car, she'll get a check for $34,000. For her, paying $800 a year to protect against a potential $34,000 loss is an absolute no-brainer. It would take her decades to save up that much money. For her, the insurance is a critical financial tool. A great rule of thumb many financial advisors use is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, you should seriously consider dropping it. For Dave's car, worth $3,000, 10% is $300. He's paying $800 a year, which is way over that threshold. It's time to let it go. For Sarah's car, worth $35,000, 10% is $3,500. Her $800 premium is well below that, making it a fantastic value. So you see, collision and comprehensive are all about protecting your property. They are your shield. They are optional if you own your car, but absolutely essential if you have a loan or a valuable vehicle. They ensure that a single bad day, a moment of distraction or a freak act of nature, doesn't lead to a devastating financial loss. Now you understand how to protect yourself and how to protect your own car from crashes and chaos. But there's a giant gaping hole we haven't talked about yet. What happens when the person who crashes into you is the problem? What happens when they have zero insurance, or they have the bare minimum policy that can't even begin to cover the cost of your medical bills after they run a red light? You might think their irresponsibility isn't your problem, but in the blink of an eye, it becomes the biggest problem in your life. And solving it requires two final pieces of the puzzle, two types of coverage that are often sold together but protect you from two very different, very dangerous scenarios. The first scenario is a driver with no safety net at all. The second is a driver whose safety net is so small it might as well not be there. The coverages that protect you from them are called uninsured motorist and underinsured motorist protection. Let's break down the first one. Uninsured motorist coverage. The name says it all. It protects you when you are hit by a driver who has zero insurance. And before you think, oh, that's rare, let me stop you right there. The Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That means on your average commute, you'll likely pass dozens, maybe hundreds of drivers who have no way to pay for the damage they might cause. They are financial time bombs on wheels. So let's play out the scene. You're doing everything right. You're stopped at a red light, listening to your favorite podcast, leaving plenty of room in front of you. Suddenly, bam, a massive jolt from behind. You're thrown forward, your head hits the steering wheel, and the sound of crunching metal fills the air. You get out, shaken but okay for the moment. The driver of the other car rushes over, apologizing profusely. He admits he was looking at his phone. You exchange information, and that's when he drops the bomb. I'm so sorry, my insurance lapsed last month. I was going to renew it, I don't have it right now. In that moment, your world shifts. Who pays for the damage to your car? Who pays for the ambulance, the emergency room visit, the chiropractor you'll need for the next 6 months to fix your whiplash? The other driver? He just told you he couldn't afford a few $100s for an insurance premium. Do you really think he has $10,000 sitting in the bank for your medical bills and car repairs? You could sue him, sure. But as the old saying goes, you can't get blood from a stone. A lawsuit against someone with no assets is just a piece of paper. This is where uninsured motorist coverage becomes your financial superhero. It steps in and acts like the insurance the other driver should have had. It pays for your injuries, your passengers' injuries, your lost wages, and your pain and suffering, up to the limits you selected. It's called uninsured motorist bodily injury, or UMBI. In some states, you can also get uninsured motorist property damage, or UMPD, which pays to fix your car. However, if you have collision coverage, that will also fix your car regardless of who is at fault, so UMPD can sometimes be redundant. But the bodily injury part? That is absolutely critical. Without it, you are completely at the mercy of a stranger's financial irresponsibility. Now, that's the first dangerous scenario. But the second one is, in many ways, even more terrifying, because it starts with a false sense of security. This is where underinsured motorist coverage comes in. Let's change the scene. This time, the accident is more severe. You're driving through an intersection on a green light when a car blows through their red light and T-bones your driver's side door. The impact is violent. You suffer a broken leg and a concussion. You spend weeks out of work, followed by months of grueling physical therapy. The bills start piling up. The hospital stay, the surgery for your leg, the MRIs, the rehabilitation costs, the income you lost from not being able to work. You add it all up and the total comes to $90,000. The police report clearly states the other driver was 100% at fault. And here's the kicker, he has insurance. You breathe a sigh of relief. For a moment, his insurance company calls, they're very polite, they accept full liability. And then they tell you that their client has the state minimum bodily injury liability coverage. In many states, that's just $25,000 per person. Let that sink in. Your bills are $90,000. The insurance of the person who caused all of this will pay a maximum of $25,000. After their check clears, you are still facing a $65,000 mountain of debt. A debt caused by an accident that was not your fault. This is not a rare fringe case. Millions of drivers carry only the absolute bare minimum insurance required by law because it's the cheapest option. They are technically insured, but they are dangerously underinsured for any kind of serious accident. This is the nightmare scenario that underinsured motorist coverage, or UIM, is designed to prevent. Once the at-fault driver's insurance pays out its maximum limit, your UIM coverage kicks in to cover the rest. It bridges the gap. So, in our example, their insurance pays the first $25,000. Then your UIM coverage would step in to pay the remaining $65,000, assuming your UIM limit was high enough. You are, in essence, buying extra insurance to protect yourself from the inadequate choices of others. You see why these two coverages are so important. They form a protective shield around you and your family's physical and financial health. Liability coverage protects your assets from others. Collision and comprehensive protect the asset of your car. But uninsured and underinsured motorist coverages protect you, your body, your ability to earn an income, your future. Now, when you're looking at these coverages on your policy, you'll see the limits look familiar. They're often written the same way as your liability limits, like 100/300. That would mean your policy provides up to $100,000 for a single person's injuries and up to $300,000 total for all injuries in a single accident. My strong recommendation is to set your UM/UIM limits to be at least equal to your own bodily injury liability limits. If you think you're worth protecting others for $100,000, shouldn't you protect yourself for that same amount? There's one more crucial detail here, a concept called stacking. It sounds complex, but it's a simple choice that can make a world of difference. If you have more than one car on your insurance policy, you can often choose between stacked or unstacked UM/UIM coverage. Unstacked is the default. If you have $100,000 in UIM coverage, that's the most you can collect, period. Stacked coverage, which costs a little more, lets you combine the coverage limits for each car on your policy. Let's say you have two cars, and each has a $100,000 UIM limit. If you have stacked coverage and you're in that bad accident, you can now stack those limits together, giving you a total of $200,000 in available coverage. If you have three cars, it's $300,000. It's an incredibly powerful way to multiply your protection for a relatively small increase in your premium. Not all states offer it, but if yours does, it is absolutely worth asking about. Think about what we've just covered. We're not talking about fender benders anymore. We're talking about life-altering events. The kind of events that can happen to anyone at any time, no matter how defensively you drive. You are sharing the road with people who have no insurance, and people who have so little it barely counts. You cannot control them. You cannot control their choices, their distractions, or their financial situations. The only thing you can control is how well you prepare for the moment your worlds collide. Having robust uninsured and underinsured motorist coverage is not about being pessimistic. It's about being a realist. It's about creating a personal safety net for your health and your wealth, a safety net that doesn't depend on the responsibility of a total stranger. We've now built the core of a fortress-like policy: liability to protect your assets, collision and comp to protect your vehicle, and now UM/UIM to protect your own well-being. But there are still a few key components left: the practical add-ons and specialized coverages that can turn a massive headache into a manageable inconvenience. These are the coverages that handle the immediate aftermath, paying for things you might not even think about in the chaos of an accident, including one that pays for medical bills no matter who is at fault. That specific coverage is called medical payments coverage, or MedPay. Think of it as the first responder for your wallet. It's a relatively small amount of coverage, typically ranging from $1,000 to $10,000, and it pays for immediate and necessary medical or funeral expenses for you and your passengers if you're injured in an accident, regardless of who is at fault. It covers things like health insurance deductibles, co-pays, ambulance rides, and doctor visits. If you're a pedestrian or cyclist and you're hit by a car, your own MedPay coverage can even step in to help you. It's fast, it's simple, and it doesn't wait for a lengthy fault investigation to kick in. You get hurt, it pays, end of story. It's the financial equivalent of a paramedic arriving on the scene to stop the bleeding before things get worse. But in about a dozen states, this concept is taken to a whole new level. These are called no-fault states, and in most of them, you are required to carry something called personal injury protection, or PIP. If MedPay is a first aid kit, PIP is a fully staffed emergency room. It does everything MedPay does, covers medical bills for you and your passengers no matter who's at fault, but it goes so much further. The real magic of PIP is that it covers things that can be even more financially devastating than the medical bills themselves. The biggest one? Lost wages. Imagine you're in an accident and you break your arm. The hospital bill might be a few $1,000s, which is bad enough. But what if you can't work for 6 weeks? For most people, that's a financial catastrophe. 6 weeks of no income can lead to missed rent, late car payments, and a mountain of debt. Personal injury protection is designed to prevent this. It can reimburse you for a significant portion of the income you lose while you're recovering from your injuries. This is a game changer. It transforms your car insurance from something that just fixes your car into something that protects your entire livelihood. And it doesn't stop there. PIP can also cover what are called essential services. Let's say you're a stay-at-home parent who gets injured in a crash. You can't take care of your kids, you can't clean the house, you can't do the things you normally do to keep your household running. PIP can provide money to hire someone to help with those tasks, things like childcare or house cleaning, while you recover. It recognizes that your labor, even unpaid, has real economic value. Finally, in the worst-case scenario, PIP also includes a funeral expense benefit. It's a grim topic, but it provides a crucial financial cushion for a grieving family during an impossibly difficult time. So while both MedPay and PIP cover medical bills without regard to fault, PIP is a far more comprehensive safety net. It's designed to make you whole again, not just physically but financially. If you live in a no-fault state, you'll be required to purchase it. If you don't, you might have the option to add it, and it's an option seriously worth considering, especially if you're self-employed or don't have robust short-term disability insurance through your job. Now let's step away from the immediate medical crisis and look at the next big headache. Your car is now a twisted piece of metal sitting in a tow yard or a body shop. Could be there for days or more likely weeks. Meanwhile, you still have to get to work. You still have to pick up the kids from school. You still have to live your life. How are you supposed to do that without a car? This is where our next optional coverage becomes not just a convenience, but an absolute necessity: rental reimbursement. This one is exactly what it sounds like. If your car is in the shop for repairs due to a covered claim, meaning an accident or event that your collision or comprehensive coverage is paying for, rental reimbursement coverage pays for you to get a rental car. It's not unlimited, of course. Your policy will specify a per-day limit and a total maximum limit. For example, you might have coverage of $30 a day for a maximum of 30 days, or a total of $900. You might see it written as 30 of 900. Now, $30 a day might not get you a luxury SUV, but it will absolutely get you a reliable compact car to keep your life moving. Think about the alternative. The average repair time after a significant accident can easily be 2 to 3 weeks. A basic rental car costs, let's say, $40 a day. Over 3 weeks, that's 21 days. $40 times 21 days is $840. That's $840 you would have to pay out of your own pocket, right after you've already paid your deductible, all while dealing with the stress of the accident itself. Or you could have paid an extra, say $5 a month on your premium for rental reimbursement coverage. It's one of the best bargains in insurance. It turns a logistical nightmare and a major surprise expense into a simple, predictable process. You drop off your wrecked car, you pick up a rental, and your insurance company handles the bill. And what about getting your car to the shop in the first place? If you're in an accident, your car might not be drivable. If you're on a road trip and your alternator dies in the middle of nowhere, you're stuck. This is where the final piece of our aftermath puzzle comes in. Towing and labor, more commonly known as roadside assistance. This is another optional coverage that provides an incredible amount of peace of mind for a very small cost. It's the safety net for when your car fails you. If you have this coverage and your car breaks down, you can make one phone call and your insurance company will dispatch help. This typically covers towing to the nearest qualified repair facility, but it's often much more than just towing. Roadside assistance can also include services like changing a flat tire, jump-starting a dead battery, delivering a few gallons of gas if you run out, or even locksmith services if you lock your keys in the car. For just a few dollars per policy term, you get a 24/7 helpline that can save you from being stranded on the side of a dark highway. Without it, you're stuck calling tow companies yourself, trying to figure out who is reputable, and then paying $100, $200, or even more dollars out of pocket for a single tow. With it, it's all handled. So let's put this all together. Let's paint two pictures of the same accident. In picture A, you have a basic state minimum liability only policy. You get into a crash that's your fault. You injure your passenger, and your car is undrivable. You pay $200 for a tow truck. You pay your passengers $5,000 or bill out of pocket until your liability insurance eventually reimburses them. A process that can take months and strain your relationship. Your car is in the shop for 3 weeks, during which you spend over $800 on a rental car just to get to your job. The accident has now cost you thousands of dollars out of pocket, not to mention the immense stress. Now let's look at picture B. You have a well-rounded policy with these optional coverages. The same accident happens. You make one call to your insurance company's claims line. They dispatch a tow truck, covered by your roadside assistance. Your passenger's $5,000 ER bill is immediately covered by your $10,000 MedPay limit. No questions asked, preserving your friendship. The next day, you pick up a rental car, paid for by your rental reimbursement coverage. The entire chaotic, terrifying, and expensive ordeal is transformed into a structured, manageable process. The total out-of-pocket cost to you? Just your collision deductible. That is the power of a complete policy. It's not just about meeting the legal requirement. It's about building a fortress around your financial life. MedPay and PIP protect your health and your income. Rental reimbursement protects your mobility and your daily routine. And roadside assistance protects you from the immediate crisis of being stranded. These aren't just add-ons. They are the tools that turn a basic insurance policy into a personalized shield. We've now covered every major piece of the car insurance puzzle. From the core liability that protects others, to the coverages that fix your own car, to the policies that protect you from uninsured drivers, and finally, to the essential services that manage the immediate chaotic aftermath of an accident. You now understand the function of every gear in this complex machine. But understanding the parts is only half the battle. The final step, and the one that saves you the most money, is knowing how to assemble them. How do you choose the right limits? How do you pick a deductible that makes sense for you? And what are the hidden discounts and insider secrets that can cut your bill by hundreds, or even thousands of dollars a year? That is the ultimate question we are about to answer. Let's start with the big one. Liability limits. This is not about your car. It's about your entire financial future. The minimums required by your state are a joke. They are dangerously low. If you cause a serious accident and only have state minimum coverage, you could be sued for everything you own. Your house, your savings, your future wages. The single best rule of thumb is this: your liability coverage should be, at a bare minimum, equal to your net worth. If you have $100,000 in savings and home equity, you need at least $100,000 in bodily injury liability per person, and $300,000 per accident. If you have a net worth of $500,000, you need $500,000. Why? Because lawyers for the person you hit will look at what you're worth, and that's what they'll sue you for. The insurance company's job is to protect your assets. Don't cheap out on the one coverage that protects you from financial ruin. For most people, a good starting point is what's called 100/300/100. That's 100,000 for bodily injury per person, 300,000 total per accident, and 100,000 for property damage. If your net worth is higher, you go higher. And if it's significantly higher, you should be looking at a separate umbrella policy, which is a cheap way to add $1 million or more in liability protection on top of your auto and home policies. Next, how do you choose your collision and comprehensive deductibles? This is much simpler. The deductible is the amount you pay out of pocket before the insurance company pays a dime. The question you need to ask yourself is brutally honest. If I crash my car tomorrow, how much cash can I come up with without going into debt or panicking? If your emergency fund has $5,000 in it, you can probably handle a $1,000 deductible. If you only have $500 saved up, you absolutely should not choose a $1,000 deductible. A higher deductible means a lower premium, and that's tempting. But the savings are often not as big as you think. You might save, say, $15 a month by raising your deductible from $500 to $1,000. That's $180 a year. But are you willing to risk an extra $500 out of pocket to save $180 a year? For some, that's a good bet. For others, it's a recipe for disaster. The emergency fund test is your best guide. Never pick a deductible that's higher than what you have readily available in cash. Now for the part you've been waiting for, the secrets, the discounts. This is where you claw back hundreds of dollars from your insurance company. We are going on a treasure hunt, and you are going to be shocked at what you find. First, the basics. Bundling your auto and home or renter's insurance. That's a no-brainer, often a 10 to 25% discount. Good student discount. If you or a driver in your house has a B average or better, that's cash in your pocket. Safe driver discount. Obvious. Don't get tickets, don't cause accidents. But that's just scratching the surface. Let's go deeper. Are you a member of any professional organizations? An engineering society? A teachers' union? A nurses' association? Many of these groups have negotiated special discounts with insurance carriers. Did you go to college? Check your alumni association. They almost always have a partnership. Are you a member of a credit union, AARP, Costco, or Sam's Club? All of these offer significant affinity group discounts that most people never think to ask for. You need to call your agent and literally list them out. Don't assume they know. Let's talk about how you pay. Most people pay monthly. But if you can afford to pay your 6-month premium all at once, in full, that's often an instant 5 to 10% discount. Signing up for automatic payments from your bank account, another small discount. Going paperless for your bills and documents, another discount. Individually, they're tiny. But stack them together, pay in full plus autopay plus paperless. You're suddenly saving $100 a year for doing almost nothing. Think about your car itself. Does it have an anti-theft system like an alarm or a tracking device? That's a discount. Anti-lock brakes? Discount. Daytime running lights? Discount. These are safety and security features, and insurers reward you for them. Again, don't assume they've automatically applied them. You have to ask. Here's a big one that people ignore: a defensive driving course. Yes, you have to give up a Saturday and maybe $50. But completing an approved course can knock 5 to 10% off your premium for 3 solid years. Do the math. If you're paying $2,000 a year, a 10% discount is $200. Over 3 years, that's $600 in savings for one boring Saturday. The return on investment is massive. And then there's the controversial one, usage-based insurance. This is where you let the insurance company monitor your driving, either through a small device you plug into your car or an app on your phone. It tracks things like how hard you brake, how fast you accelerate, the time of day you drive, and how many miles you drive. Now, the privacy concerns are real, and you have to decide if you're comfortable with that. But if you are a genuinely safe, low-mileage driver, the discounts can be enormous. Up to 40% in some cases. If you work from home and barely drive, this could literally cut your bill in half. But of all the secrets, of all the hacks, one stands above all others as the single most powerful tool you have to save money. It's not a discount. It's a strategy. It's the act of shopping your insurance. Insurance companies do not reward loyalty. In fact, they often penalize it. They use a practice called price optimization, which is a fancy way of saying they figure out the highest price you're willing to pay without leaving. They slowly creep your rate up year after year, betting that you won't go through the hassle of shopping around. They are counting on your inertia. And for millions of people, that bet pays off for them and costs you. You must, at least once every 2 years or every single year if you can, get quotes from other companies. I'm not talking about one other company. I'm talking about getting at least 3 to 5 competing quotes. Call an independent agent who can shop multiple carriers for you. But also go online and get quotes directly from companies that don't use agents. You need to attack this from all angles. The person who has been with the same company for a decade is almost certainly overpaying, sometimes by over $1,000 a year for the exact same coverage. Your current company might be the best deal for you this year, but their prices could be uncompetitive next year. The only way to know is to check. The 45 minutes it takes to shop around could be the most profitable 45 minutes of your entire year. So let's put it all together. Here is your action plan. Right now, after this video, I want you to find your car insurance declarations page. First, look at your liability limits. Do they protect your net worth? If not, your first call is to increase them. Second, look at your deductibles. Do they pass the emergency fund test? Can you afford to pay them tomorrow? Adjust them to a level that lets you sleep at night. Third, make a physical list of every single potential discount we just talked about. Your job, your alumni group, your car's features, everything. Call your current company and ask for every single one you might qualify for. And finally, armed with your new, optimized coverage levels, take that policy and shop it with at least 3 other top-rated insurance companies. We started this journey looking at a document that felt like a foreign language, filled with traps and confusing terms. But now you see it for what it is. It's a contract, a tool. And you are now equipped to be the master of that tool, not its victim. You know the difference between liability and collision. You understand what uninsured motorist coverage is actually for. You know how to choose limits that protect your family and deductibles that protect your savings. And you know the hidden pathways to cut your costs without cutting your vital protection. This knowledge gives you control. It transforms car insurance from a mysterious, frustrating expense into a strategic part of your financial plan. This isn't just about saving a few $100s. It's about buying peace of mind intelligently. It's about building a shield around the life you've worked so hard to create. You now have everything you need. Go take control.